Hey everybody, I'm really pleased this morning to introduce one of my really good friends, Vince Pace. Vince is the president at Barnett REI Investment Finance, somebody that I work with very, very closely. A lot of my investors currently have loans with Barnett. Process goes very, very smoothly. I was speaking to Vince the other day, and we were talking about how investment real estate is handled, and he's got some real interesting observations. I think this is going to be really helpful for everybody. So, Vince, how long have you been at Barnett?
So I joined Barnett in 2013.
Okay, and you're the president there.
Of Barnett Real Estate Investment Finance, yes.
Great. And so, what kind of products or what's the value with Barnett Real Estate Finance? I know there's a ton of lenders in the space, a lot of people that are in the Chicagoland market. What really distinguishes Barnett from other lenders?
I think the things we would want to highlight would be speed, flexibility, and certainty. Once we say we're going to close, we're going to close. We often scoop up deals from other lenders who are at the closing table, and for one reason or another, they back out, they run out of capital, whatever the situation may be. That doesn't happen with us. We don't do every deal, obviously, but if we're not going to do a deal, we're not going to get you to the closing table and then walk away. The speed part is crucial. In this space, you've got to be able to close quickly in order to get a deal, and we need to make sure that our clients have the funds available to do that. So it's not uncommon for us to be able to close in 5 business days or so. We've done it quicker a few times, although that requires sort of the stars to align. Everything needs to be in place. There needs to be no issues. And then when you talk about nimbleness, we get deals done that others can't. We're not limited in the 1 to 4 residential. We can do commercial. We can do retail, office. We can do situations where the structure is different. We've lent to people with ongoing foreclosures. And we do that by, structuring it in a way where, it's something of a joint venture. So we find ways to get deals done when it's a good deal. If you got a good investor who's got liquidity to get the deal done and who's got a good deal, we'll do what it takes to figure out how to close that deal for them.
That's awesome. I know that when I see Barnett Capital on the other side of one of my contracts, we did a lot of volume last year. We were fortunate to be number 4 in Chicagoland out of 5,000 real estate firms in terms of volume closed. And for my investors, being able to turn their capital, turn their properties very, very quickly, have predictability in the closing process. A lot of times we're closing with banks that have extension fees. Sometimes they're not reaching out to you right after the contract is signed, so then you have to mobilize. And I always know when I see Barnett on the other side, we're going to have an appraisal done, and we're going to close on time, and it's going to be smooth. When you and I were talking the other day, you mentioned this concept about loss of capital, and I just thought that was just incredibly awesome because most people, they call me and they say, how much do you charge for an attorney fee? And that's the only question they know to ask. Even though we have discounts for title, and we provide relationships, and for you, I imagine one of the things the only people ask you is, what is your rate? But you were talking about this concept of loss of capital, which I thought was a huge thing for investors to be asking their lenders when they're talking to them. Tell me a little bit more about that.
Sure. So when people are looking at getting financing, they focus on the rate because a lot of the competitors in the space, that's what they market. They market the rate. What is really the question that investors want to be asking is, what is the total cost of capital? Is the cost of capital increased by points, by junk fees? And sort of most hard to see the amounts that the interest is actually charged on. So when you think about getting capital from somebody like us, there's really 4 places that I'd want everybody to look at to really run their numbers and make sure that whatever they select is the best fit and the cheapest price for their transaction. And those 4 things are the rate. The rate is one component, obviously. Then there's the points. A point is just a percent of a loan paid at the beginning, typically. So if you have a $100,000 loan, 1 point is 1%. It's $1,000. Another thing will be junk fees. We see term sheets from our competitors, and we see HUDs from our competitors, and there's $1,500, $2,500. We've seen some with as much as $7,000 in junk
When you
fees.
say junk fee, everybody's got different levels of acumen here. So junk fee, would that be like a origination fee or application fee?
Well, the origination fee is generally part of the points, but the junk fees would be things that go to the lender's pocket. It's not paying the appraiser, it's not paying some third party, it's not paying the title company. It's money that the lender charges, and that just becomes income to the lender. It would be things like underwriting fees and document fees and processing fees, and just all these. There's all sorts of different fees that they sort of assign, but the numbers can be pretty large, and it ends up becoming a big portion of the capital. When you have $100,000 loan and you've got even $1,500 in junk fees, that's increasing your annual rate, assuming you close it in a year, by 1.5%. So your rate might be 12, but now it's 13.5 because of these junk fees. Then you add points and other stuff, it gets up there even more quickly. So
And you were telling me about one thing that I thought was like, wow, that's like such a huge insight is when someone gets a construction loan, that lenders structure that differently.
Sure. Yeah. A lot of people in the space charge on construction amounts from the day the loan closes, even if those amounts have been unfunded, even if those amounts are still sitting with the lender and not with the borrower. So you can imagine, like, let's say you find a deal where you're going to put 120 grand into it, but you're buying it for next to nothing. You're buying it for 40 grand. If it takes you 3 to 6 months, let's say you have a tough time getting the permit, it takes 3 to 6 months. You're under those people who charge that way, under those lenders who charge that way, you're getting charged on $160,000 for those first 6 months when you're fighting to get that permit in place, even though you haven't gotten a dime of that 120. And that even if you have a rate of 12%, your rate is effectively quadrupled for those 6 months because you're paying on a much larger amount than what's there. So that's the fourth item after interest, points, junk fees. It's what is interest charged on? And that's a hidden one. It's not obvious from day one when you're comparing. If you simply look at rate or even rate and points and junk fees, you're not really getting the full calculation of what your costs of capital are going to be until you take into account what is interest charged on. There was a great example of a client who had a deal, and he initially brought it to us. And it was a new construction deal, almost new construction. And he had a big construction budget, very little upfront costs, but he got stuck in permitting for a solid 9 months. Like, he really got banged up in permitting. And he was paying interest on the entire construction budget, not the 120 he had put on the property, but it was more like 400, 500 grand for 9 months. And when I went there and met with him on that project, I was like, kind of like, I told you so. If you would come with us, look at how much less you would have paid. It was unfortunate at that point that he had already sunk points. He had already sunk all this into that other lender. It didn't make sense for us to take him out at that point. But had he come with us at the beginning, we would have saved him a 5-digit number on that transaction. It was not insignificant.
That's great. So I don't know if this is sinking in for people, but you've got to really dive deep in on all the terms of these loans with your strategic partners. It's incredible. 3, 4, 5 years ago, sourcing properties, it was like shooting fish in a barrel. Right now, my investors are fighting tooth and nail to find properties, and that amount of profit at the end of these flips has gone down. So being on top of these fees is critical. I didn't realize that some lenders will charge on money that they haven't actually put out on the street yet. So that's literally, that could be tens of thousands of dollars, right?
Absolutely.
So, if the average flip is, if somebody's making now, in the old days, it was pretty routine to make $30,000 or $40,000 on these residential, smaller residential homes, $250 purchase price. Now we're down in the $15,000, $20,000, $25,000 range, and an extra $10,000 and paying ordinary income on their profit. They've just paid their profits to their lender.
Yeah, these amounts can quickly add up to a big chunk of what would have otherwise been profit in the pocket of the investor, for sure.
And are you telling me that Barnett REI Finance, that on construction, is that a term they need to negotiate with you, or is that something that's just standard out of the box? They don't have to worry about it.
That's standard out of the box for us. We only charge on amounts funded on all of our financings.
Okay, so I mean, if people are thinking about, Vince was talking to me, and maybe take them through, Vince, with traditional financing, how they get an APR, but in the private lending world, there is no APR.
Sure.
So how does that work? And explain APR, because I'm a little bit, I'm not a numbers guy. So help me out with that.
Sure. So when you walk into a bank and you're looking to get a mortgage for your home, you look up on the signs they have in the bank, the marketing they have in the office there, and it'll say, here's our mortgage rates, here's your APR. It's your annualized percentage rate. And the reason banks do that, they're required to do that, is because it allows consumers to make apples to apples comparisons. And what is an APR? An APR takes in any cost associated with the loan and translates that into an annualized percentage rate. So you know if the rate is 4%, 5%, 6%, without needing to think about, well, what does this $1,000 fee do? Or what does this $350 fee do? It takes it all into account and makes a single number. So your average consumer walking in off the street can look at that sign and say, oh, okay, well, this 30 year is cheaper than this 20 year. And here's the APR on these things. You can quickly understand. That protection in terms of financing is not available in this investment space. So most lenders do what the banks were doing prior to this being imposed upon them, which is hide fees in the small print, make it unclear what the total cost of capital are. So they sell you on a 12% rate, which sounds great in this space, but the rate ends up being annualized 20% because they add in all these different fees. So you as an investor have to protect yourself. You can't rely on the government coming in and imposing regulations on the space, because they haven't, and I don't think that they will. Whereas, in the residential mortgage space, they wanted to protect the moms and pops out there who were getting hurt by, banks kind of putting things in the small print. Because you have to do that yourself here, you got to run the numbers. You've got to make sure that you're calculating what your total cost of capital will be. We actually have a tool, a calculator that we can share. If anybody needs that, just reach out to me. I'll send it right over. And it lets you compare lender A to lender B. It calculates what the total cost of capital. And what does that mean? That's the dollar amount that you're going to pay to that capital provider over the entire course of the financing with them. So that lets you say, okay, well, capital provider A, I'm going to end up giving them, based off of how I think this deal is going to go, $4,000, and capital provider B, I'm going to give them $5,000. Well, that's easy. I only want to pay $4,000. So it allows you to quickly make these decisions. And those are the kinds of numbers you always want to be running. One other thing I'll throw out there is that there's calculators out there on Bigger Pockets and on other places on the internet where real estate investors are active. And what we found is that those calculators often calculate interest off of the entire loan amount the entire time. So if you're using some calculator and it doesn't ask you what is interest calculated on, it's probably incorrect when comparing lenders who only charge on amounts funded and lenders who charge on everything the whole time.
And Vince, if they want to get this this calculator from you, how can they reach you?
Sure. So there's a couple different ways you can reach me. One is to go to our website, barnettreifinance.com. Again, that's barnettreifinance.com. You could also call us at 224-205-7266, or you can email me directly at vpace, that's V as in Vincent, P as in Peter, ACE at barnettcapital.com.
So, if this isn't sinking in for people yet, I mean, you really need to listen to this, because I can't tell you how many RIAs I've been to, how many different real estate investor events I've spoken at, how many clients I've talked to, and I hear you speak, and immediately at the end of all this great information, somebody raises their hand, and the first question they ask is, how much is your rate? And then from there, all they hear is, I call it Snoopy. They don't hear anything. Want, 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 want. And if you're going to be a successful investor, you have to be smarter and you have to dive deeper into this. It's not just about asking a lender how much their interest rate is, a home appraiser what the cost of the appraisal is. You've got to see what value is being brought to you and understanding these things like cost of capital. Now, Vince, I think you guys actually are local right here in Chicago. I know sometimes I work with finance companies out of California and other places. I mean, one of the values that I really like about you guys is it's a family-owned company that's right here in Chicago. If I need to speak to the president, I pick up the phone. I can always get a hold of you. So you're based where in Chicago?
So we're based in Northbrook.
Okay. And
yeah, we so in contrast to most of these other lenders out there, the overarching, Barnett REI Finance is a Barnett Capital company. Barnett Capital invests in real estate and in alternative finance. This company, Barnett REI Finance, really comes out of Barnett Capital's real estate experience. So we're real estate guys who are providing capital. I find that most of the other lenders in the space are financial guys who are providing to the real estate space. So we find that we have a better understanding of how these deals go, of the muck that you get into. I think that's one of the advantages of working with us. When, at Andrew Holmes' events, he always says, if these guys are saying no on a deal, you need to take a hard look at that deal because, these guys have been doing real estate for decades. And I think that's a big advantage we have over the average company that just gets an appraisal and says, okay, here's the appraisal. We catch appraisals that are low and we catch appraisals that are high. And I don't think your average lender who doesn't have the same real estate experience we do can really, claim that that's something that they can do regularly.
So I'm gonna challenge you to something, and I don't know if you'll be able to do it. I'm not going to hold you to the exact numbers, but okay. I really want to hone in on this on construction financing.
Okay.
So let's just say, as an example, there's a 50,000, or let's call it a 70, whatever number you want, $75,000 rehab. Okay.
Okay.
And we don't need that $75,000 for, say, 120 days.
So I'm going to actually open up that calculator I discussed before, and I'm going to put your scenario right in there. Give me 1 second as I pop it open here.
Awesome. Because I really want people to see what the dollars are on just this one component. Now, Vince talked about 10 different components that we need to be looking at with respect to loans. And if you have a good relationship with a lender, talk to your lender about these things, negotiate these things, call Vince up. But I want to really, instead of talking in the abstract, dive into what this actual number is.
All right, so I got my calculator up in front of me. So start me with the purchase price. What are we paying for this property?
Let's say we're going to buy this property for $150,000.
150, and our construction budget is 75.
Yeah.
Okay. Now here's where the important question comes out. Because we're charging on amounts funded, we need to know when that money gets funded to you in order to make an accurate calculation. So that divides down into two questions. How many draws are you doing? How much will each draw be? Well, just how much will each draw be, and when will those draws be? So
let's say we're running into this property's in the city of Chicago. We got to submit architectural plans, and we're not even going to be able to pull our first draw for 90 days.
Okay. So let us put that there. So we'll take the closing date and we'll add 90 days to it. And first draw, what are we going to say? We're going to do 3 draws, 4 draws in this deal?
Let's do 3 draws, 25 apiece.
Okay. And then when do your next 2 come out?
What do you what's average, Vince? You know more about this than me.
Let's call it 30 days after the first one, each of them. That's not a super fast pace, but it's not crazy. All right, so this would be a deal then in Chicago where you're finishing up the construction in about 6 months. That's a little on the fast side. but you might be able to pull that off. With inspections and stuff, things can get pushed back. Okay, so then what are we going to compare this to?
Well, what I want to see is, in general, what the delta is for the money that would have been charged by another lender when that $75,000 was charged from day one. Is there a way to figure that out?
Yeah, there is. So here are the rest of the assumptions I got. Let's just make the rates equal. Let's just say, we have a program where a standard rate is 16.99. Let's just put 16.99 for both. And in that case, if they have the same exact rate, so the only difference now between the two is that the one charges on the full amount and the other doesn't. It's a $6,000 savings on this deal we're describing.
$6,000. That doesn't include any of the junk fees you're describing, all those other factors that we need to look into. So, I mean, if the average amount of profit on one of these deals is $20,000, you're literally talking about a third of your profit going to the lender.
Yep. And then here's another, just to mix up the example a little bit. If you take it, so you use one of our traditional program rates of 16.99, and that rate sounds high, right? It's a higher rate than you see in the market. And yet here I've got a competitor now. I've put them in here at 12%. I've put 0 junk fees, which is unrealistic, and I put 2 points. And with 2 points, 12%, it's basically a wash. We're basically the same as them. Now you add their junk fees in, and that's what's going to change it. But this is where that APR question comes in. What I'm calculating here is I've got a 9-month sale time. So all this money gets paid back after 9 months. And at 9 months, it's basically even. But if you add in the junk fees, you see, even $1,000, I mean, that's just money right out of your pocket and into theirs.
That's crazy. Well, Vince, thanks for taking me through that. I mean, what's really important for investors is to take these value add propositions, and this is really tough for anybody that thinks real estate investing is easy. It's not easy. There are just anybody who has 2 pennies to rub together has thought about investing in real estate. So you have to be smart. You have to ask the right questions. So Vince, thanks for kind of sharing some insights on how people need to be thinking about things and the right questions to ask. Again, you're right there in North Chicago. Give everybody your phone number and your email and your website address again, so that if they weren't able to take it down, they can take it down now. I'm giving everybody a second to pull out their pen. Vince, give them your contact information, and then they'll have it. Sure.
Our website is Barnett, reifinance.com. That's BARNETT, reifinance.com. The phone number we can be reached at is 224-205-7266. And you can email me at vpace@barnettcapital.com.
Awesome, Vince. Thanks for taking some time with me today, and hopefully we'll see you soon at one of these real estate events.
Thanks for having me.
All right, thanks.